Hey everyone, welcome back to the channel. Public sector banks are taking a beating on the markets for the second day in a row. Major players like State Bank of India are facing significant sell-offs, and it seems like the outlook is getting even tougher. So if you are invested in banking sector or just want to stay ahead of the curve, stick around till the end. Shares of public sector banks have been declining for the second consecutive day, dropping by up to 4% in intraday trading on the National Stock Exchange this Monday. The sell-off continued from Friday after Goldman Sachs downgraded State Bank of India from neutral to sell. The brokerage firm also slashed its target price from 841 to 742. Looking at the longer term perspective, Nifty PSB Bank Index has corrected nearly 20% since it hit its 52-week high of 8053 on 3rd June 2024. Goldman Sachs cited several challenges that led to the downgrade, pointing out that the return on assets for SBI has likely peaked. The analysts anticipate a possible derating in the bank's valuation as they see growing headwinds affecting the sustainability of the bank's ROA. They expect SBI's return on asset to decrease from a peak of 1% in FY24 to below 1% by FY26. The analysts also predict slower loan growth due to widening gap between deposit and loan growth, alongside rising credit costs from increased slippages in the MSME, agriculture and unsecured loan portfolios. They believe the risk-reward profile for SBI is becoming unfavorable under these conditions. For SBI, analysts suggest the focus has shifted to the narrowing spread between return on equity and cost of equity. They note that historically, whenever credit concerns have grown, the cost of equity has tended to increase. If rural economic distress worsens or potential farm loans waivers come into play, they expect the cost of equity to rise further. They also see limited potential for return on equity to improve due to shrinking net interest margin or NIM and rising credit costs which could put pressure on SBI's valuation multiples. Meanwhile, Emkay Global Financial Services also projects that credit growth could slow down to 12 to 13% in FY25. This is due to expected slowdown in unsecured retail loans following the Reserve Bank of India's actions and continued liquidity pressures. Furthermore, new liquidity coverage ratio or LCR norms and potential rate cuts in US followed by India by the end of the year could add more pressure on margins, particularly for private sector banks. The public sector banking space, especially giants like SBI, is clearly facing some headwinds with downgrades and concerns over growth and valuations. It's a dynamic situation and it will be interesting to see how things unfold in the coming weeks. If you found this breakdown helpful, don't forget to hit the like button and subscribe to the channel for more updates on market trends. And if you have any thoughts on where you think the PSB stocks are headed or how you are navigating this market, drop a comment below. We would love to hear from you. Thanks for watching and we will see you in the next video. Stay tuned, stay informed and happy investing.